Hello and welcome to the latest edition of Citrus Bites, live from our offices in Sevenoaks. I'm Richard Harris, and today I'm delighted to be joined by David Braithwaite. Good afternoon, David.
Hi there, Richard.
Now, for those of you that watch Citrus Bites regularly, you will know that I love to start this with an update on the UK economy, the Bank of England base rate, inflation numbers. I'm not going to do any of that today. And the reason I'm not is because it feels like today's a day I need to talk about the USA and Japan, because over the last few days, there has been a lot of noise about the USA and Japan on what's gone on with the markets and potentially the economy. And it's quite hard to miss the deadlines, the headlines. And I've been reading headlines that use the words, and I'm sure you've seen some of them: crash, plunge, Black Monday, bloodbath, market madness, all of these really great words that as investors we really enjoy seeing. Completely not. So we're going to talk a little bit more about why that's happened, what's going on, and then we're going to ask David, really, so as investors, what do we do at this point? So let's start with the US and why the US matters. So let's just look at the context of the actual IMF stats as to the size of the largest economies in the world. And you can see here that the US and China are so far out in front in terms of size, and the US being at number one. If there is the slightest concern about a possible downturn in the economy in the US, the known impact in terms of the wider ripple starts to kick in. And that's why the US seems to drive so much of what happens elsewhere in the world. So now we understand the size of the economy, let's look at what news it was that kind of broke on Friday that started the rumor around, well, actually, is this downturn going to be a little harder than originally expected? And for those of you that haven't seen it, it was called the non-farm payrolls. So you may be sat there going, what on earth is a non-farm payroll? Well, actually, it's nothing more than it's the number of people employed in the US, excluding, may not be a surprise here, farming, private households, not-for-profit, and those in active military. So they think it includes about 80% of those in the US that contribute to GDP. So quite an important reading. This comes out every single month. The forecast for this month is that the number of people employed in these sectors would go up by about 175,000. Actually, the number came in a lot softer than expected at 114,000. It also meant that the US unemployment number was ticking up slightly from 4.1% in the previous month to 4.3%. Now, in itself, of course, you might go, well, 114,000 still doesn't sound like a bad number. And I will say the same thing. It's a one number in isolation. And for those following Citrus Bites, you'll also know I've talked about the Federal Reserve in the US, that's the central bank. And at the start of the year, the expectation, how many times the Federal Reserve and Jerome Powell, who heads up the Federal Reserve, would reduce base rates in the US. And that's not happened at all. And it's not happened at all because actually the economy has been running really well. So I'm just going to remind everyone again, this is one piece of data against an economy that's been running particularly well. However, it was enough short of the projected figure that it did cause that initial concern over whether the US economy was as healthy as had been hoped. The one thing to add here is that the Federal Reserve has always said they will use data to decide when the right time is to reduce rates. They haven't reduced the rates so far this year. Obviously, unlike the UK, where the Bank of England has reduced, unlike the European Union, that's obviously where the European Central Bank has reduced rates. So at the moment, the Federal Reserve is standing out for not reducing rates. So maybe, as opposed to being a terrible shock here with a number that's come out way short of expectations, actually, maybe it's just the number the Fed was seeking to give that impetus to make that first rate cut, as opposed to anything more than that. Now, we'll know that in about the middle of September when the next time that the Fed meet. So that's a little bit of a story about what happened in America. And at that time, clearly, for those of you that see the tech stocks, many of these names you might be familiar with, like Meta, like Apple, these tech stocks have been running very, very strong so far this year, and they influence the market significantly. So any slight wobbles in the market can cause quite a big downshift in the market performance very, very quickly. And likewise, it goes the other way. They can cause an uptick in the economy and the markets very, very quickly too. So enough about America. That's the story there. Let's just flip over to Japan very quickly. Story in Japan. What a place to be. So interest rates in Japan went up in March for the first time in 17 years. 17 years. They actually had negative interest rates. So interest rates popped up very slightly just above zero in March. And then the Bank of Japan increased interest rates in Japan at the end of July. Again, a tiny bit more. So they're still very, very, very low. What's the problem with this? Well, actually, what happens is because the yen, which is the currency they use there, has been relatively weak because of the negative interest rates, it's meant that anything they import, and some of these things are really important in Japan, such as oil is quite an important part, it's an essential. Oil has been very expensive for them to buy. And actually, the Bank of Japan have decided to intervene here. Interest rates have been put up. And what that has meant is that it's slightly cheaper for them to buy these essential imports. Now, unfortunately, there's a bit of a every cloud here. And by doing that, Japanese exports become more expensive to other people, which can, of course, impact the sales that Japanese companies, and some of these names in the Nikkei 225 market are very well known to you, such as Sony and Honda. A real concern here that sales in those companies will be impacted by what's happened with the yen. So actually what you saw here on Monday was a huge one-day reduction of 12.5%. What you maybe didn't hear so much was the Nikkei's performance on Tuesday, which jumped up by 10.5%. And maybe this is just reinforcing slightly that, good news doesn't sell as much as bad news. So if you'd missed that, worth noting that the Nikkei had another uplift day on Tuesday and another positive day on Wednesday. So after that one day significant drop, followed two quite big, promising uptick days. And the one other point I want to mention about Japan that's worth noting. So this one gets a bit more complicated, but both professional investors and retail investors have been known to go to Japan over the last few years and carry out what's being called as a carry trade. And in essence, what they're doing is they're borrowing money in a currency where an interest rate is very, very low, and then taking that to a currency where an interest rate is very, very high, and using the currency fluctuations in order to potentially make either equity purchases or invest the money in a way that makes money. Clearly, with that change coming, where the yen is now getting stronger and potentially a risk in the US where the economy is faltering slightly, actually that trade starts to become one that needs to be closed out. So you get a lot of that happening right at the same time as America's non-farm payrolls coming out, and suddenly what you get is a really violent swing in the market. And like I say, not surprisingly, over the next couple of days, what you've seen is a tick back to the upside. So I hope that gives you a very brief understanding about what's been going on over the last couple of days. I've tried to add through the slides that you've seen a little bit of context, like the Nikkei. Worth noting, you may have spotted the 12.5% drop on Monday, but did you realize the market was nearly 100% up? The 225 biggest companies in Japan were nearly 100% up in valuation compared to 2020. So, worth remembering where we've come from in the last 4 years to consider that one day of fluctuation before we hit Tuesday and that upward turn. So there's an economic story for you, a little bit of background as to what's been going on. But actually, so as an investor, when you're seeing this playing out, that becomes a lot more difficult to try and work out what to do. So I'm delighted David can be with us today, because can't think of anyone better really to kind of try and help us understand. David, if I'm an investor and I'm seeing this play out, what do I do? I've enjoyed some quite significant gains potentially so far in 2024. Markets have been good, economy's good. What do I do now?
Well, it's always a really interesting question. I've been around for so long that I've seen lots of these highs, but also the lows that go with these as well. And it's like anything in life, you have to work at it. And sometimes with your money, it's got to go down before it goes up. So our message is always stick to the plan. It isn't a get rich quick scheme that we sort out with clients, but I do appreciate, and it's even harder these days to miss the bad news. When you see the news on the TV, we've all got the phones, and you can see, for those of you that have got the Quilter app, you can log in and you see the values, and it's almost like that micromanaging it. You see it coming up, you see it go down, but good news doesn't get the same weight as bad news. So when things go down, it makes us feel a lot worse than what we have with the same percentage of it going up. What's also interesting is when things go down, people always then think, well, is it going to go down? Is it going to go further down? What should I do? Should I stick with it? Am I taking too much risk? So lots of things go through people's heads. It's a psychology of investing. And what I find as well with people is for all of us, and I'm an investor too. You know, what Richard is as well. We all have got our money in different things that we're investing in within funds. So we feel the highs and we see and we feel the lows. Now, it's different people are at different stages of life. And I understand, you know, if you're retired and you're thinking, well, I'm not got any more new money coming in. This is my money that I've got. It feels far more important to you to make sure that you're looking after your money and that we're doing what we can do to reiterate that. But we do that by not taking too much risk with your money. We're really careful about deciding what funds and what risk that you want to take with the fund money that you've got there, but also make sure we look after it and monitor that and keep those funds on their toes, keep you informed as what's going on, and above all, be there to answer questions. Because it's all very well when things are going well. You know, nobody rings us, funnily enough. When the markets go down, we get all the phone calls saying, what should I do? When it goes up, we rarely get people saying, oh, thanks, my investment's gone up, because that's just the way that we are. But the thing is to stick with it. And interesting, actually behind my head here, this is a graph for those of you that have been in the office and seen this. And you can have a look when you come in. That is actually a graph. I know it's hard to see on here. That's the stock market since 1925. So if I showed you an investment that looked like that, you'd think, well, that's great, it goes up. But when you actually look in on some of the details where you get the drops here, and the red and the blue, by the way, is Labour and Conservative, just in case you're wondering, but it's about that long-term plan. It isn't a get-rich-quick scheme. It's stick to the plan, do what you say you're going to do, don't panic. I know that's a lot easier said than done. Things will get better, and they do, and they can get better really, really quickly, as you heard with Richard about saying how the bad news got the attention, the good news didn't get so much of the attention, but it always comes out okay in the end. But we make sure that we keep you safe. If anything, we're probably more conservative with your money than a lot of other people might be or want to be, but we just want to make sure we deliver a positive result, but above all, be here to answer any questions that you've got about how things are going. But often I find that we can save people from themselves as well. And what I mean by that is that when we had COVID happen, for example, lots of people were panicking, going, well, do I get out? Do I go and move my money to cash because I don't know when it's going to go? And we're saying, stay with it, stay with it. But those people that stayed with it, they had the biggest return, as Richard will remember, on their actual investments that they had if they'd gone into cash. And then by the time you then try and time the market, not about spending the time, you try and time the market, by the time you want to do something, you've already missed it because you're reacting to what's happened. You're reacting to history. What we're not trying to do is to predict the future, but make sure you're always in the right place at the right time and help you steer that ship towards getting a positive outcome for you. But it isn't a get-rich-quick scheme, Richard. It's just about sticking to the plan. We do everything, all the due diligence that goes on behind the scenes to make sure you're in the right place and in the right funds, and to keep monitoring that for you is what we're here for. That's what we get paid to do. And we just want to make sure we keep delivering on that promise to you.
David, that's really helpful. Thank you. And I know it feels when you read some of these headlines, you do feel like maybe you're the only person that's feeling the way you do. So it's actually reassuring to hear from people like you that that's probably not the case, and actually that there are things I can do in terms of either picking up the phone or talking to my advisor if there's something I want to talk about, etc. Then I can do that. And actually, it reminds me a little bit of our recent meeting when we recorded with Lindsay James. So for those of you that haven't seen the video with Lindsay James, which is only a few weeks old now, actually Lindsay picks up on some of this in terms of our psychology as well when we read the headlines and how we react. So we'll attach a link to that video again. If you haven't seen it, it's well worth a watch. I suggest you do that. David, I really appreciate the support. Thank you very much. Thank you for the words today. And that's it. Enough for this month on Citrus Bites. I hope it's been useful. I hope it didn't get too difficult around Japan and the USA. But look, we'll always try and give you and provide you with the information that you want to hear about and you want to know more about. So thanks for watching, and I look forward to seeing you again next time.